Hey everyone, in this video I'm doing chapter 5 of Trading Price Action Trends, which is about signal bars and specifically about reversal bars. So in this presentation I'm going to talk about what is a reversal bar, the characteristics of a good reversal bar, the highest probability reversals and Al's recommendations, and what to watch out for if you're trading reversals. Just want to mention that I've kind of arranged everything in a way that made it easy for me to understand. So that's how I'm presenting it. All the content from the book is in this presentation, but it's arranged slightly differently. So I just wanted to make a note of that. Also, a lot of the examples I use are bull cases. So it's a bull reversal bar. I thought it still makes it clear. The concepts are still clear, but if you would like me to use examples for both sides, I do use the bear case a little bit, but I use the bull case more often. So if you'd like me to use examples to show both sides more often, then I can do that in future videos. So what is a reversal bar? A reversal bar is a one-bar event showing immediate rejection of price. So this is different than a two-bar reversal. Here on this day, November 19th, if you look here on bar 13, where my cursor is now, that is an example of a two-bar reversal. We have a bear bar coming to the low of day, but there's no immediate rejection. The bear bar closes on its low. Then you see the next bar closes on the high. So this entire reversal, a breakout below this low and an attempted breakout below the low of day, happens over the time period of two bars. There's no immediate rejection of price. Here on the right side, on bar 51, we have a breakout below the low of day, a breakout below bar 50, and as the market breaks down below these levels, it quickly reverses back up on the same bar. So this is a sell climax and then a climactic reversal. A sell climax plus a bull reversal, all within the same bar. So it's happening very quickly. It's showing bullish urgency in this case. So it represents a sell climax and an immediate reversal up on a lower time frame. And this is, again, for a bull reversal bar. Here you can see a bull reversal bar. We have consecutive climaxes down, and this is the first time in this sequence that we had an attempted bear breakout, but reversed all the way back up and closed near the high of the bar. Here we had a small tail on the bottom of the bar. Here we had an attempted move up, but the bear sold it right away and it ended up closing near its low. We have these tails showing buying pressure, but no sustained buying pressure. This is the first time that we had the bears attempt to go lower, but it was quickly bought up by the bulls. So that's a change in character. It's not a good buy for a bull trend, but it was the first time that we got a two-legged pullback because it's a sell climax and a bull reversal up. On the right side, you can see what it actually looked like on the 1-minute chart. So this reversal bar on the 5-minute chart is shown in this boxed area on the 1-minute chart. And you can see that it's an attempted break below the bear trend channel line. And as Al mentions, when the market tries to break below a bear channel, it usually reverses back into the channel within 5 to 10 bars. So here is an attempt of bears to show strength late in a bear trend, breaking below the trend channel line. They got the attempted breakout, but then bulls got a breakout. Remember, a bull trend bar is a bull breakout as well. And so we have a bull breakout that led to a channel and eventually two larger legs up. So the bears got their attempted breakout, but it failed, and bulls reversed the entire breakout and got back within the bear trend channel. So this is a sign of bulls urgently making the breakout fail and trapping bears who tried to accelerate the bear trend. So this whole situation is happening within one bar. That's why it's a one-bar event, and it can show signs of bullish urgency for a bull reversal. Here's an example of a very strong bull reversal bar. We have a double top bear flag 35-38, and it's a trending trading range day. So usually when you start off the day with a trading range and you get a breakout, it's usually a brief breakout that leads to a lower range. And I'm aware that a lot of these terms like trending trading range day and double top bear flags, those haven't been covered yet. So if you're using these as reference as you go through the books, you may not have covered that yet, and that's okay. All those things will be explained in future chapters in the book and in future videos of mine. So I hope I'm going to try to clarify some things as we go along, but all the in-depth work for those topics will come later on. So because this is a possible trending trading range day, we have a double top bear flag. And once we get the bear breakout here, you can see that we break below the double top bear flag. This is possibly a final flag because of the prior context. It's a possible trending trading range day. So this is a possible final flag. And so the bears try to get a breakout, and all the bears who sold here aggressively trying to get the bear breakout of this double top bear flag to succeed end up getting trapped as the bulls buy it up aggressively within the same bar. And now we have a bull reversal bar closing near its high. And Al mentioned on this day that buying above 40 was a reasonable buy. He actually bought a 4-point pullback. I think he bought a 50% pullback of bar 40 and 41. So he waited for it to pull back and then bought, just to decrease his risk a little bit. But he did mention that bar 40 was a reasonable buy. And that's because it's a reversal bar after bears are trapped selling below this double top bear flag. So this is the type of bar that we're looking for, where bears are trapped and bulls buy it up aggressively within the same bar. So we mentioned this first point. The second point is that a reversal bar is a signal, but it must be supported by the context. So first we look at the context and make sure that a reversal is worth taking, and then we start worrying about the quality and the characteristics of the bar itself. And so here, for example, on bar 9 and bar 15 and bar 21, these are all bull reversal bars, or they have the appearance of a bull reversal bar. Bar 21 is not a textbook reversal bar, but bar 9 and bar 15 are. But the context here, and I did buy above this one, which is a mistake. So this lesson is as much for me as it is for anyone else. We can't just look at a reversal bar and see that it meets the characteristics of a good reversal and buy it, because the context has to be supportive. And as I mentioned in the last video, for the context to be supportive of a reversal, we have to break a trend line strongly and then test the extreme and then form a reversal bar, which is what we get here on bar 73, the bar with the arrow next to it. So that is a type of high 5 setup. We had a attempted wedge bottom, and then we tried to get a breakout and then got a second entry on 73. So that's the type of reversal bar that would meet the criteria of a good context to look for a reversal. Looking for the perfect signal bar is much more important when we're trading counter trend. When we're trading with the trend and buying pullbacks in a trend or selling pullbacks in a trend, we can be much more lenient with the type of bar that we're using as a signal bar. So for example here, buying above 26 is a second entry buy with 23. It's keeping the gap open with the neckline. Typically that's not a good signal bar. It is closing above its midpoint, but it's a bear body. However, if we use a correct stop, that's an okay buy above 26. Same with bar 33. It's a second entry, it's a micro double bottom, but it's a doji. However, in a strong trend where the gaps are staying open, it's a reasonable buy if we use a correct stop. Here as well, it's 2 legs down, or double bottom bull flag, 39.45. So this is 39 where my cursor is. This is 45. Here's this first entry. Here's a second entry. It's a doji, but again, bulls bought above it because we're able to be much more lenient in a strong bull trend. And as I mentioned in chapter 4, as Al mentioned in chapter 4, the strongest trends need to have bad signal bars because it's trying to have traders guessing and always buying in small pieces. So not only does it make sense and is it okay to buy above less than perfect signal bars in strong bull trends, but he actually argues that they're necessary. Now, I wouldn't use that as permission to just buy above anything all the time, but and it's going to come with experience, but I think you can be much more lenient and the market is much more forgiving if you use a correct stop in very, very strong trends. Now, normally, as a general rule, when the market doesn't give us a signal bar in the direction of the trend, so a bull body in a bull trend, we haven't seen signs of the market owning a bar. So it hasn't, in this case, bar 26, the bulls haven't owned the entire bar and forced it to close on its high. So it's not as strong as it could be. But I think the point Al's making here is that in the right situations, we can be less picky when the trend is strong, as long as we're trading with the trend. So the minimum for a reversal bar, in this case it's a bull reversal bar, is when the close is above its open. So if the close is above the open for a bull reversal, it's a bull body, or with a close above its midpoint. So in this example I was showing, bar 26, this first arrow, it's not a perfect reversal bar. It doesn't close above its open. It's not a bull body, but it does close above its midpoint. So that's the minimum criteria for a bull reversal bar. Something important that Al mentions often is that just because something meets the minimum criteria doesn't mean that we should act on it or see it as optimal or ideal. The minimum criteria is just that. It's the bare minimum to be considered a reversal bar. And so we should only use that criteria, the minimum criteria, when the context is extremely supportive. However, when we're looking at reversals, major reversals of bear trends or bull trends, the threshold has to be very high to take that signal. And so it should be of higher quality and meet more of the characteristics of a good reversal bar. Whereas if we're buying or selling in very strong bull trends or very strong bear trends, respectively, then we can probably go closer to the minimum criteria when we think the context is very conducive to a reversal, like buying a bull flag in a bull trend or selling a bear flag in a bear trend. So now we're going to talk about the characteristics of a good reversal bar. The first criteria that Al points out in this chapter is that the reversal bar should open near or below the close of the prior bar. So I'm going to go through each part of this statement and show examples. So open near or below the close of the prior bar, and this is for a bull reversal. So if we look at this chart here, there's a signal bar with the white arrow next to it. That's the sequence of bars, these three bars here, 20, 21, 22, 23. In the top, you can see that enlarged in the top right corner. So in most cases, the bar will open where the last bar closes. However, in this case, you can see that this reversal bar actually opens a tick below the close of the prior bar. And so in this case, it actually has, it shows overly aggressive bears. There were so many orders to sell the close of that bar that the only way you could find buyers is to jump down one tick. And so that shows overly aggressive sellers. And bears sold all the way down this bar, but it was bought up immediately and actually closed all the way up here on its high. So we have a lot of trapped bears shown by the aggressiveness of the sell or close bears and the bears who sold all the way down here. This turned into a sell climax and a bull breakout and reversal. So it's a climactic reversal bottom, all happening within the same bar. So this is a situation where it's not opening at the close of the prior bar, it's actually opening below, which may add some strength to the reversal. The next part of the statement is that it should have a close above the open of the bar. So for a bull reversal, you'll want the bar to close above the open, so it should have a bull body. And above the prior bar's close. So in this case, it actually closed well above the prior bar's close because it closed way above the open with a big bull body. If it had only closed one or two ticks above the prior bar's close, it would not be as strong. It would look more like a doji rather than a strong bull reversal bar. So all those criteria add strength to a bull reversal bar. The second criteria is that there's a lower tail that is a third or half the size of the bar, and there's no or a negligible upper tail. So in this next slide, we're going to talk about the details of a lower tail. The lower tail represents intra-bar rejection of price. So it's a sell climax and a reversal all in one bar. And the second thing Al mentions about the tail is you don't always have to look for it. Price action is much more important than a specific pattern, looking for a specific bar. So a trader must understand what a reversal looks like on every time frame. So every reversal that you see is probably if it's a good reversal, it's probably a perfect reversal on some time frame. But Al says don't go looking for it. You should be able to read the price action. And even if it takes 12 bars to form the reversal, you should understand what the market is telling you and not have to wait for one specific bar to give you a signal to enter. And so here, for example, this is June 14th, and we had a broad bear channel, and we had 68, 69, 70 is an attempted breakout. So it's an attempt by the bears to accelerate the bear trend late in a bear trend, and or late in a bear channel. And like I mentioned, Al says if it's going to break below a bear channel, if it's going to make the attempt, it's usually going to fail about 75% of the time. It's going to fail between or within 5 or 10 bars. And so here the bears tried to accelerate the trend, and they failed, and it turned into a sell climax and a bull reversal. So this is a climactic reversal for the bulls. And on some time frame, and you can see here I have the 30-minute time frame up, it's a bull reversal bar. So it's a bull body closing near its high and a big tail on the bottom. This tail represents the bears trying to accelerate the trend down, and then the bulls reversing it strongly back up. And that led to a rally for the next 4 or 5 bars. It was near the end of the day, but that's the last attempt by the bears until the bulls reversed it back up near the middle of the range. So Al's message here is this does not have a perfect reversal bar to signal a reversal, and you don't have to go looking for the 30-minute time frame to find it if you understand what's happening here. And the second part of the statement is no or negligible upper tail. And the reason that we want as small of an upper tail as possible is because when the bar closes on the high without an upper tail, it represents that the bulls were buying all the way into the close. So it's relentless bulls. The third characteristic that Al mentions about a good reversal bar is a close that reverses, and in this context, reverses means closes above the closes and highs of more than one bar. So in this slide, we're going to talk about, or for the next couple slides, we're going to talk about when a close reverses multiple closes or highs. And again, reverses means closes above. So a tail and a trigger are not necessary for a bar to be a reversal bar. And the example that Al gives in the book is this chart, with bar 29 being the reversal bar example that he gives. And so here, this reversal bar doesn't have a high above the prior bar. It doesn't have a big tail on top, but Al still classifies it as a reversal bar because it's reversing the price action before it. And so here we have a bunch of bulls who are buying breakouts, and in one bar, it closes below the last 12 bars. And so all these bulls are trapped, and they're all exiting during 29 or exiting below 29 or waiting for some bounce to exit. And so this scenario, even though it doesn't have a perfect tail and a trigger above the prior bar and an obvious bull trap, it's still a reversal bar because it's reversing something before it. And you can see he shows the 15-minute chart of this situation, and you can see that it's right here under the number 28. It is a bear reversal bar for a lower high major trend reversal. So the important takeaway here is we just have to understand what the market is telling us with the bars that are in front of us. And on some time frame, it's going to look like this 15-minute chart with a perfect tail, but we don't necessarily need that to make these decisions, to get short or long or take a trade betting on a reversal. But we do need the right context. And so here, obviously, there's a trend line break, and it's a lower high major trend reversal. So the context is favorable for a reversal if the bar structure is supportive, and in this case, it is. So here's a bullish example on bar 62, right next to my cursor. This is a reversal bar. It doesn't quite trigger below the prior bar. It doesn't have a massive tail, but it closes above the last 3 bars and closes above the high of the last 2 bars. And the context is that we have an opening range, and like I mentioned earlier, it's a possible trending trading range day. And so a lot of traders are betting that we get back up to the open of the day or the bar 1 low. And so when we see this, it reverses 3 closes. It's a very strong bull bar. A lot of traders will buy above this bar, and Al did buy above this bar on this day. Here's another bear example. So this is actually a double bottom bull flag, and it ended up being a final flag here up to 43. And so here, this surprise bear bar down didn't trigger above the prior bar. It's not a typical or classical reversal bar. The tail is very small, but it's reversing this whole entire breakout. And so all the bulls who bought in the last 30 bars are now trapped, and they're going to try to get out any way they can, either on a bounce, and if the bounce doesn't come, they'll look to exit below bars. So the context is important. It has a trend line break, and it's a very weak rally, and we get this surprise bar down. So again, the message is understand what the market is doing, and it doesn't necessarily need to have a perfect bar for us to take action. And when I say that we don't need a perfect bar to take action, What I mean is that we don't need a perfect classical reversal bar with a big tail on top and a big bear body. We can understand what the market is telling us based on the price action and infer that this is a reversal on some time frame and the context is conducive to a reversal. So we still need the bar to show strength. We still want to sell below a big bear trend bar if we're looking for a bear reversal, but we don't need it to look like an exact classical bear reversal bar. The fourth criteria is not much overlap with the prior bars. So Al considers overlap to be when the midpoint of a bull reversal bar is above the low of the prior bar. And so the tail extends beyond the prior bar by only a couple ticks. And so right here on bar 12, actually let me put an arrow just in case it's hard to see. So bar 12 here, it's at the moving average. The tail only goes below the prior bar by a couple ticks, or a point or so, and then reverses up. But what's important here is that this bar is also overlapping a lot with the last 3 bars. And so Al says that when the reversal bar only goes a couple ticks or a very small distance below the prior bar and also has a lot of overlap, so the midpoint of the bar is above the prior bar's low, and it's in some kind of a semblance of a tight trading range. Like here, you could argue when this bar formed, bar 12, that we're going up, down, up. It looks like it could be a tight trading range. So when there's some evidence of overlap and we don't have a clean reversal bar and it's coming after a bear breakout, Al says to be careful because the reversal bar has to be seen within the context of the prior price action. And here, this could just be a bear flag after a bear spike. And so sometimes if there's too much overlap, the market might be forcing you to buy at the high of a tight trading range like here, which is a trading range on a lower time frame. And so here, this ended up being a double top bear flag, and I actually bought above bar 12. And I got stopped out. I got chopped up a little bit here. But I bought there thinking it's a bull reversal, but actually I was just buying high in a tight trading range after a bear spike. And there's a lot of examples of overlap in this chart. You can see here where my cursor is on bar 46. The tail doesn't go that far below the prior bar, and it closes on the high. But look at the 5 bars before it. It's just a tight trading range below the moving average. And so bulls didn't buy above there. A lot of bears actually sold above there because it's the top of a tight trading range. So maybe bears on a lower time frame are just seeing this as high in a local trading range. And a lot of bears are selling up here. Same with this bar. 1 tick below the prior bar and close on the high, but a lot of overlap with the last 4 bars. And it looks like it was just high in a tight trading range again and a test of this breakout point. So that takes experience. I still struggle with it. Like it's really hard to constantly judge when a bar is overlapping enough to stay away, but it's especially true in tight bear channels, in bear breakouts, because it increases the chances that you're just buying at the top of a bear flag. And so that's the second point. Context is key. The market may be forcing you to buy high in a tight trading range, which is a local trading range. In a tight trading range, the reversal is the move. So where I bought here above 12, I was seeing it as a reversal, but it was actually just a move. It was the entire move up to the top of the trading range. There was no more room for it to go. So this entire bar is not a signal for anything more. The entire bar is actually just a bounce. It's the entire move up to the top of the tight trading range where bears will sell and bulls will exit their positions and bears will start to sell. Right here, bar 47 is another example. So we have a big tail on the bottom and possible failed breakout closing near its high, but bear sold it because it's coming after a tight channel, 4 bear bars, and this is just buying too high in a possible bear flag. So these are things to keep in mind to watch out for overlap, which would negate the strength of the reversal bar. Now, this is interesting because this happened May 3rd, 2021. I had an order to buy above bar 20, and I didn't get filled. So I didn't learn a lesson here because I didn't lose any money. But here, this was September 21st, where I did buy above, and that's when I learned my lesson. You can see they're very similar situations. We have a bear breakout on bar 8, and then this tight trading range. And in this example, we have the strong breakout below the moving average on bar 17 and this tight trading range. And so when I got stopped out here, I remembered that there was a similar situation. And I actually went back to one of Al's webinars. And I don't know if you can see the numbers here, bar 14 and bar 15. My cursor's right at bar 15. Al actually sold the 15 high. Again, this is a very similar situation, very tight channel down, bear breakout on bar 12 here. And then bar 15 looks like it's reversing up for a second entry or for a micro double bottom. But because the channel down is so tight and because we have a strong breakout 11, 12, Al actually sold 15 high. Strong bears are selling up here because it's you're selling at the high of a tight trading range, at the high of a bear flag in a bear spike. And that is very similar. You can see the overlap, the 2 pushes up and the 2 pushes down. It's very similar to these situations here. Up, down, up, bear sold up here. I bought, but strong bear sold. And here, up, down, up to a double top bear flag, and bear sold that close. So now instead of buying there, I'm looking to sell there. But that takes the understanding that we're in a situation of overlap, and it's a tight enough channel down that we might get one more push down. So it's something to be aware of. This is the example that Al showed in the book. It's a tight channel down, and we have a second entry buy above the bar above number 1. But Al's saying that's not a good buy because it's a tight channel down, and when you have a tight channel and the market's forcing you to buy high, you could just be buying high in a tight trading range. So the trade is not to buy above 1, it's to sell below 2. It says strong bears are selling up here and selling below 2. Now overlap, being aware of overlap is much more important when trading counter trend. When trading in a bull trend, you can see here this arrow, there is overlap, but it's also a pullback. It's a moving average gap bar buy in a bull trend. It's a high 4 buy setup. It's closing above the moving average. So the context is more supportive, even though there is overlap. So overlap is always important, but it's much more important when you could be buying at the high of a tight trading range or high of a bear flag in a tight bear channel or in a bear spike. Here, this looks like a bull flag with 2 legs down, and it's in a bull trend. So the context matters a lot when judging overlap, especially true when trading counter trend. The last criteria here is that the reversal bar is not followed by a doji inside bar. Ideally, it triggers right away and forms a strong entry bar. So I'm going to talk about this and break it down so that it becomes more clear. So dealing with reversal bars plus dojis. So Al says if you get a doji inside bar before the trade triggers, it's better not to take it. And so here's an example. This is one that did work out, but you can see above bar 51, we had the bull reversal bar, and it had a 2-tick tail, or close to a, I think it's a 1-tick tail actually. And instead of triggering it, we pulled back right away, and we formed a doji inside bar. Now this bar closed on its high, and the trade did work out, but this is a sign that bulls are not pushing up with urgency. Why didn't this bar close on the high, and then the bulls continue to race up? Why did it pull back? That shows that there's some remnants of selling pressure here. So it could not trigger right away, instead went sideways for another 5 bars. So we might just be forming a tight trading range instead of a rally. Now here it did work, but Al's saying be careful when the bar doesn't trigger right away and the next bar is a doji inside bar. It's similar to a situation like this where we had a bull reversal bar and then we had a bear bar. And then it triggered on the next bar after that. It went above the bull reversal, but it's coming after a bear bar now. So now it's just up, down, and then up. So it could be a tight trading range. And here you can see it failed. So it's just to be aware that we want the bar to close on the high because it shows urgency by the bulls. But if they don't trigger the buy right away or get continuation right away, then there's not really much urgency and it could just be a tight trading range. The second way of dealing with dojis after reversal bars is if you get a doji entry bar. So it does trigger the buy. In this situation, it does trigger the signal bar, but it doesn't go anywhere. It just becomes a doji entry bar. If that's the case, Al says base it on the context. Don't move the stop to below the doji. So here, for example, this is bar 7 on March 7th. Al did buy above bar 7. He bought above 7 because it was a parabolic wedge down to yesterday's low. And but when he saw bar 8, it was a doji bar. So that's a doji entry bar. It rallied and came back and closed below the 7 high. Al said he exited break even on 9. He did that because it's a tight channel down with a lot of selling pressure. And how come after closing near the high and getting a bull reversal after a failed breakdown below yesterday's low, how come the bulls couldn't race this up? How come we got a doji and more sideways price action for 5 minutes? In this case, Al said it's worth exiting break even because it's not showing urgency. In this case, he says do not put the stop below bar 8. Don't put the stop below the doji entry bar because the doji is a trading range. So it might go below it and then race up. So it's not worth putting the stop below that doji. Either exit break even, or if the context is good, you can stay long with your stop below 7 or with a wide stop. Here, he decided to exit break even. Now in this scenario, it was a possible trending trading range day, which I've shown multiple examples of this in this video. So this is a trending trading range day. He did buy above 41, and then he got a doji entry bar. In this case, he opted to stay long because of the context. So he didn't exit below 41. He actually bought 10 points lower, betting that we would eventually get back above the 41 high. That's more advanced. I'm just using that as an example to show that once you get a doji entry bar, it shows a lack of urgency, but based on the context, you can decide if you want to use the stop below the signal bar, if you want to use a wide stop, or if you just want to exit break even. Here, he chose not to exit break even because he thought there was potential to scale in and that we'd enter a lower trading range, which we did. But the takeaway here is if you get the doji entry bar, it's not a good idea to put the stop below the doji. Either stop out at your wide stop or below the signal bar, or just exit the trade break even and wait for more clarity. Here's another situation where Al bought above bar 54. It's a good reversal bar, consecutive climaxes, and it's a parabolic move down. The trend channel line is getting steeper and steeper. So that's a criteria for a possible reversal up. Al bought above 54. 55 was a doji. Because it was a failed breakout below the low of the day, he gave it 2 bars, the entry bar and the follow-through bar. When the entry bar and the follow-through bar both showed signs of selling pressure and couldn't get bulls buying or bulls showing strength, he exited on the close of 56 on this second bar with the tail on top. You can see a lot of bulls exited there and a lot of bears sold. That's why we got this big, strong bear bar that followed. So it's all about reading the context and understanding, is it worth keeping a wide stop? Is it worth staying long with your stop below the signal bar? Or is it better to just give up on that particular trade and wait for more information? And so many times when Al's trading these reversals, he's not just leaving a stop down here and hoping. If there's no sign of immediate urgency, he's looking to exit break even and only staying long if the context is very supportive. In this next section, we're going to talk about the highest probability reversals. I've shown a lot of reversal bars in bear trends, but the highest probability reversals are reversal bars after a flag in a trend. So here, for example, this bar right above the white arrow is a reversal bar in a small bear trend within an overall bull trend. So this reversal bar is reversing this small bear trend, which is a bull flag, but you're still looking in the overall bullish direction. So it's a reversal bar, but it's with trend. And these are the highest probability reversals. So traders should look for a reversal of a local bear trend, which is a bull flag, within a larger bull trend. So this bar is another example. This is a bull trend, and on a lower time frame, this is a small bear trend with 3 legs down. So this reversal bar is reversing the small bear trend, but you know you're still buying in an overall bull trend. So this is a very high probability reversal, much higher than the ones I've showed earlier, because these are all coming after a strong bear move and not in a clear upward trend. So this is actually looking for the major trend to reverse, whereas in these examples, we're just looking for the minor small bear trend to reverse in an overall uptrend. Most reversals occur without a perfect reversal bar. So in most situations, the reversal on your chart won't have the classic reversal bar with the large tail on the bottom and the big bull body for a bull reversal and the big tail on top with a large bear body for a bear reversal. Reversals are going to take all different shapes and forms. But it's important for us, as I mentioned earlier, that we understand what the price action in front of us is telling us. And we trade the pattern in front of us and not necessarily look for the perfect reversal bar. Now, that being said, the odds are higher when the signal bar is a trend bar in your desired direction. So just because most reversals happen without a perfect reversal bar. Doesn't mean that we can just go and trade any reversal and imagine what it might look like on a different time frame. It's still better to be buying, if we're buying in a bear trend looking for a bull reversal, it's better to be buying above a bull bar closing near its high. So it's always better if the signal bar is a trend bar in the desired direction. And the best thing for us to do is to focus on trading with trend. So trade those high probability reversals, which are bull flags in bull trends and bear flags in bear trends, and only take the best reversal setups. So when we're looking for a reversal of a major bear trend or reversal of a major bull trend, wait for the context to be right and only take the best ones. Otherwise, just focus on trading with the trend. In this last section, we're going to talk about some things to watch out for. So the first thing is watch out for big reversal bars that close as dojis, because when they close as dojis, they're one bar trading ranges that lack bullish conviction. So here, for example, bar 44, right here where my cursor is, it had a big tail on the bottom. It's a failed breakout below the low of day, but why couldn't it close with a big bull bar closing near its high? Why couldn't it close above the prior bar's close? Those are signs that the bulls are not as strong as they may seem just because of this tail. So this is a form of sell climax and bull reversal, but it's lacking bullish conviction. That's very different than this scenario with this huge bull bar closing near its high. It's different than the first example I showed with this bull bar. It's a similar situation. We have a failed breakout below the low of day in a large trading range, but this bar closed all the way on its high and above the prior bar's close. Whereas this one here, it's also a failed breakout below the low of day in a large trading range, big up, big down, but it couldn't close as a bull body. That's a sign of weakness and a lack of bullish conviction. Now, something important worth mentioning here is that Al says when you have a reversal bar with a big tail and a small body, it has to be evaluated in the context of the prior price action. And so in the book, he gives an example similar to this one, where we have a clear trading range. We have clear signs of buyers in this area, in this price range. And we had really strong bullish price action earlier in the day. So bulls might return at this price. And so when we get a strong tail here with a small body, it becomes a discretionary option for a trader to buy above that bar and base it on context. So it's not a perfect reversal bar, but if the context is supportive and a trader makes that call, then it's reasonable to take it. So this is a similar example to what he shows in the book, where a trader may take it, betting that the bears won't come back in until we test the moving average. Now the same argument could be made here. A bear could take that above 44 because it's a failed breakout. We had earlier strong bullish activity. And if they did take that, then they may use the criteria of what to do when we get a doji after a reversal bar. So here we have two dojis after the reversal bar, no strong signs of buying pressure. We kept the gap open below the breakout point. So a lot of those things may make bulls exit. And you can see that a lot of bulls exited there and a lot of bears sold to close. So it's a little bit of a tougher read when we have a big tail and a small body or a bear body, and it has to be based on context, and that's going to come over time with experience. The second thing to watch out for is reversal bars with tails on top. We mentioned earlier when we discussed the characteristics of a good reversal bar that we want a lower tail that is a third or half the size of the bar and no or a negligible upper tail. And the reason we want no or a negligible upper tail is because we want bullish conviction in the bull case and bearish conviction in the bear case. We want to make sure that in a bull reversal, the bulls are owning the bar and showing enthusiasm all the way into the close of the bar, and that they don't lose that conviction into the end of the bar and create a tail on top, because that will show that the bears are still present during a bull reversal. And if a bear reversal bar has a big tail on the bottom, it means that the bears lost conviction near the close of the bar and that the bulls are still present. So ideally, we want to watch out for situations where the reversal bars have tails on top in the bull case, and when reversal bars have tails on the bottom in the bear case. The third thing we want to watch out for is reversal bars that are much smaller than the prior bars. So this chart I showed earlier, I said Al bought above bar 7, the bar next to the arrow. And I use this as an example of what Al said to do after a reversal bar if the entry bar is a doji bar. But this is also an example of buying above a reversal bar where it's much smaller than the bar before it. All the bear bars, the first bar, the third bar, and the sixth bar, are all bear climaxes, and they're pretty large. This reversal bar, bar 7, is a small bull body compared to the bear climaxes. But because it's a parabolic wedge and a failed breakout below yesterday's low on the open, it's a possible opening reversal. So it might be worth taking, but it's something to keep in mind that in any other context, if the bears have bars that are this strong compared to a small bull body like this, it might be worth letting it go. And finally, the fourth thing to watch out for is reversal bars that are the entire move. And this is common in tight channels and tight trading ranges. And so we mentioned this a lot in the section on overlap, when the reversal bar is actually just a move up in a tight trading range. And this entire reversal bar is just the entire move up. And as soon as the bar closes, we're now near the top of the tight trading range, and bulls will exit and bears will start to sell. So this is common in tight bear channels or in bear breakouts. So that's the summary for chapter 5, a little bit more in depth and a longer presentation. But I hope you found it helpful. Please feel free to leave any critiques or any areas of disagreement where your interpretation of Al's material might differ from mine. I'm always open to different perspectives. So let me know if it's helpful. Let me know if you have any comments to share. And I appreciate you sticking around. And I hope to release chapter 6 as soon as possible.